Hello and welcome to FT Markets. Well, oil has got everybody talking. We've got sectarian violence on the upsurge in Iraq, and for the markets in general, this is not a good thing. And as US consumers prepare to take their long road trips this summer, they're going to discover some pain at the gas pump. So joining me to discuss how this could all unfold is Gregory Meyer. He's our commodities guru here in the markets team in New York. Greg, thanks for joining us.
Good to be here.
And what's going to happen here, do you think?
Well, in the last week, we saw benchmark crude oil rise close to $116 a barrel, which is the highest since last September. That's up about $5 a barrel from a couple weeks ago. A significant jump after a period of extremely low volatility, where you've had Brent kind of hovering around 110 for months and months. And the fear seems to be the possibility of lower exports out of Iraq. We haven't actually seen a reduction in exports at this point, but as we saw back in 2011 in Libya, a kind of a brewing sectarian war can quickly escalate and have a real impact on crude supplies. For the U.S., Iraq is significant, although less so as a supplier. The U.S. imports about 200 to 300,000 barrels a day of crude from Iraq today. That's down from about 600,000 barrels a day as recently as 2008. And that's largely thanks to the shale drilling boom here in the U.S., which has lifted production by about 1 million barrels a day annually. But overall, I mean, oil is a global market, so even if the U.S. is buying less, world demand's growing, and if there's less of it available, it's going to be reflected in the price.
Right, you made an interesting point here about low volatility in the oil markets. This is something we've seen across all markets in general, although if you talk to equity traders and some bond traders, the reason they are alarmed about oil and what's happening in the Middle East is because they do see the potential for a sudden surge in the price and a sudden pickup in volatility that could feed into other markets, such as equities and bonds, etc. How likely is that scenario this summer?
At this point, oil volatility has ticked up a bit in terms of historical volatility because of the Iraq situation. But if you look at a longer-term chart of volatility, it is still remarkably low. And there's some hedge funds, some other traders are beginning to bet that volatility will pick up. And it could pick up with a sharp price move either to the upside or the downside in oil, and that could have certainly could unsettle plans for some corporates like big fuel hedgers such as airlines, and have a reflection on their performance.
I mean, the other downside, of course, of rising oil prices and energy prices in general is that it hurts U.S. companies who are under some pressure now. We're seeing Wall Street analysts lower their revenue expectations for the second quarter and later this year, but also for consumers who basically drive cars. Now, in the past, this has always been a big issue in America because so many people here drive cars. Whenever there's any jump in petrol prices at the pump, there's this massive outpouring of alarm from consumers, and you obviously hear politicians wade into this as well. Could it be different this time?
So far, the reaction at the pump has been very modest. The average retail regular gasoline price late last week was about $3.68 a gallon. That's only about 8 cents above a year ago, and about 3 cents above the week before, and well below the peak reached during the big oil price spike in 2008. So we've seen a relatively modest reaction so far. Gasoline does tend to follow crude to a large degree, and if there's a big spike in crude, you can expect to see a move in gasoline as well. Although I think the American consumer is less vulnerable than it was to a jump in gasoline prices. For one thing, beyond the prices just being sort of less volatile, people have become less shocked by what is historically a relatively high gasoline price. Overall, the roadway traffic is not growing in the U.S. It's relatively stagnant, and fuel efficiency is growing in the new vehicle fleet. Yes. It's up by about 25% since late '07, according to the University of Michigan. And finally, I mean, the percentage of household income spent on energy is still only about 5.5%. That's according to James Hamilton, an economist, which is well below where it was during the big oil price spike. So there's some room and some flexibility, I think, and some insulation to a big spike that we didn't see when prices went haywire about 6 years ago.
Great, Greg. Well, obviously markets and investors will be closely monitoring the price of oil in the coming weeks. And thanks for joining us today.
Thanks so much, Mike.